Why everything is selling off. Starting with Bitcoin, market crash explained 2025. Crypto, stocks, bonds. What's driving the global sell off? Bitcoin has dropped below 90,000 kilo, wiping out 2025 gains. Crypto market lost over 1 trillion in value in weeks. Headlines focus on Bitcoin, but sell off is broader. You are watching Civic Finance. I am Ahmad. Let's focus on headlines. Worldwide market are bleeding red and Bitcoin is leading the way up. But here is the key. It's not just Bitcoin. Stocks, bonds and even safe havens are under pressure. So let's break down why everything is selling off and why Bitcoin is simply the first domino. Let's discuss about Bitcoin crash. Bitcoin fell 33% from its October high of $126,000. Technical signals point to deeper bear market. Social media panic amplifies volatility. Now let's talk about Bitcoin. From October, high of $126,000, Bitcoin has dropped more than 33%. That's the third of its value gone in just weeks. And all of you will agree with me that this isn't just a healthy correction. Technical indicators are flashing bear market signals. Plus, when panic spreads on social media, volatility explodes everywhere and even faster. About macro drivers, rising interest rates increase borrowing costs. Liquidity tightening reduce risk appetite. Fed policy shifts trigger global risk of moves. But here is the bigger picture. You will find the real driver isn't just Bitcoin, it's macroeconomics. Rising interest rates turn borrowing more expensive, liquidity dries up, and investors starts dumping risk assets fast. That means crypto tech stocks and growth plays all get hit. In short, this is systematic deleveraging, not just Bitcoin crash. What effect on other assets? That means I want to tell you spillover to other assets. Equities see broad declines as funds rebalance. Bonds sell off as yields spike. Even gold and safe havens feel pressure. At once, Bitcoin falls. The domino effect means chain reaction begins. Hedge funds liquidate stocks to cover losses. Bonds sell off as yield spike. Even gold, the so-called safe haven, feels the squeeze. So the message is clear. Volatility doesn't discriminate or limit itself. It is spread everywhere. Now let compare Wall Street versus Main Street. Institutions treat this as portfolio management. Retail investors face existential risk. Small businesses suffer from cash flow gaps. How do Wall Street and Main Street behave differently? Now let's compare Wall Street and Main Street. For Wall Street, this is headache. Institutions rebalance, hedge, and move on. But Main Street, sorry, small investors and small businesses, they fight for their existence. Missing a 10-day delivery window or watching saving evaporate isn't just inconvenient. It can even mean survival or collapse. What's the difference? How Wall Street survives crashes with hedging. The safety net institutions use when markets fall. Very interesting for the risk person, for the risk institution. Hedging equals to financial insurance against losses. Tools they use: put options, currency futures, inverse ETFs, diversification. Wall Street versus Main Street response to crashes. Why hedging cushions institutions but leaves small investors exposed? Listen, volatility is systemic, but risk management makes survival position. Let's discuss about this main point. Now, let's shift our focus to Wall Street survives, crashes the hedging. First of all, hedging is essential financial insurance. Whenever market tumble, institutions don't just sit back and absorb the pain. Instead, they deploy strategies designed to offset losses. For example, they might buy put options. It's simple terms. In simple terms, that gives them the right to sell stock at a fixed price, even if the market collapses. As a result, when prices fall, the option gains value and fixed price even the market collapse. As a result, when prices fall, the option gains value and cushions the blow. Moreover, Wall Street uses currency futures to lock in exchange rate. This matters because when global markets shake, currencies swing wildly. By fixing rates ahead of time, institutions protect global markets shake. Institutions protect them. In addition, they often rely on inverse ETFs. These are funds that rise when the market falls. So while Main Street investors watch their portfolio shrink, Wall Street balances losses with gains from these hedges. Finally, as we continue this series, remember, understanding hedging isn't just about Wall Street. It is about recognizing how risk management shapes the entire financial system. What lesson and takeaway we get from here? Volatility is systemic, not isolated. Bitcoin grabs headlines, but macro drivers matter more. Investor must understand liquidity cycle. Can you imagine? What's the lesson here? Volatility doesn't discriminate, but Bitcoin may grab the headlines. But the real story is systematic. Interest rates, liquidity, and risk cycle drives these moves. And if you understand those drivers, you will be better prepared for the next wave. Finally, if you found this breakdown helpful, hit subscribe to Civic Finance for weekly market insights. Drop a comment below. How are you navigating this sell off? And share this video with anyone following crypto or stocks right now. Stay informed, stay prepared, and I will see you in the next one. Thank you.